Hello and welcome to the Alt Asset Allocation Podcast. Today's interview is with Nick Kosko. Nick is a wealth strategist at CreateTailwind. And in this episode, we discuss financial independence, taking control of your money, and questioning the financial norms, which is a key theme here at the podcast. And we also get into infinite banking, which is using your whole life insurance as collateral, which is an interesting proposition. Infinite banking has been called a scam by Dave Ramsey, a name you most likely know, but it actually might make sense for some of the listeners out there, or at least to learn more about it and how it could be used in your financial planning. Before you listen, please don't forget to like or subscribe to the podcast, or even better, leave a review. If you're watching this on YouTube, hello. Please like the video and or subscribe to the channel. It really, really helps. All right. Enjoy this episode with Nick Kosko. Nick, welcome to the Alt Asset Allocation Podcast. Excited to have you on today.
Hey, thanks, Ben, for having me. It's an honor, and looking forward to getting into the discussion.
Absolutely. And before we started recording, I saw the world's biggest water bottle. So a half gallon of water is on your desk. Hopefully it doesn't fall off mid-interview, because that'd be a broken toe or something terrible.
It makes a lot of noise when that metal flask hits the ground.
Oh yeah. I'll edit that out if that happens. No worries. Well, cool. We've got a lot to cover. Reading up on you and what you're interested in, I know that my listeners are really gonna enjoy a lot of these things. But before we get into that, let's just go over a little bit of your background and how you got into doing what you're doing now.
Yeah, well, I'm just a curious person. I've got a 5-year-old, and I always joke that I'm 44, really going on about 5, because there's so much of me in that kid. And the biggest thing is he's always asking why. And I really appreciate that curiosity that I see in my kids. And so I was born in a middle-class family. You know, we didn't need anything, but you know, it wasn't a lavish life. And I went to college. I thought I always wanted to fly airplanes for a living, fly airplanes around the world, and that's what I did. But you know, as I got into my late 20s, early 30s, I just realized there's a better way to life than going and working for someone else. And I really got curious about investing in real estate. And then 2011 happened, the 08 to 11 kind of fiasco of the financial world. And I lost my job through no fault of my own. And that really set things in motion, me going, hey, I just lost 100% of my revenue. And I didn't really care for that, because like from the real estate investing perspective, I was buying multifamilies, and I was attracted to that because of the economies of scale, right? And here I wasn't living that. You know, I had one source of income. And so I just was pursuing things. I was sitting down with financial advisors. And honestly, Ben, I left every one of those meetings. I interviewed like 6 of them here in town, and I left every one of those. And I thought to myself, something doesn't add up for me with this. I don't know what it is I'm missing. Ben, I'm just simply not smart enough to figure it out on my own. I had to keep pursuing, like, why doesn't that add up, right? And one day I was flying with a guy. Miserable trip in the middle of the night, and the best thing we could do to stay awake was we got to talking about banking. He goes, "Have you ever heard of infinite banking?" And I was like, "I have no idea what you're talking about." And it has to do with an insurance product, and I kept asking a lot of questions about that. I had my life insurance license at the time, actually, and he's like, "You're asking all the wrong questions." And I was like, "Really?" And he's like, "Just get the book." So here I am flying. I'm reading this book. I've tracked down the author to this book, this wise man, 83 years old at the time, named Nelson Nash. And I tracked him down. And frankly, Ben, it really changed my life. The connections through that 7-8 years ago of discovering how banks work, and then going and practicing what we preach now. I don't actually fly airplanes anymore. We have more than one source of income now. We're not done. I always joke that my retirement papers will be my obituary. We're going to live with purpose, And so now we're just on a mission to free people from what I call financial slavery. The noise enslaves people, and that's what I'm passionate about talking about, is how to free yourself from financial slavery. And we always say, Ben, money buys choices, and choices buys freedom. And I'm just on a quest to have as many choices as I can.
Love it. I'll probably steal that one. Money buys choices and choices buy freedom. It's very good. So curiosity and hard work, these are like my two top qualities, and I think they can make up for a lot of other ones. So those kind of trump all things. So definitely appreciate that. So I want to jump into infinite banking, what it is, why it's important, all of the things. But I'm curious, kind of stepping back, as you went down this path of like more financial enlightenment and this financial slavery, and kind of thinking through these and reflecting a little bit more on life, are there any books that you read or things that helped shape this new vision, this new perspective that stick out in your mind?
Yeah, I would say like Think and Grow Rich was a big one for me. I would say that Rich Dad Poor Dad by Robert Kiyosaki was that one changed my life right there. Like Kiyosaki, I'm sure plenty of people in your audience are familiar with Kiyosaki, but I mean, he champions himself on being an educator. And I love how, culture does this, right? We tend to follow a herd, right? And Kiyosaki says these disturbing things, which have great appeal to me, because my instincts tell me when everyone's going left, I want to go right. And Kiyosaki just drills right at that, like that story, which is a fictitious story of the rich dad and the poor dad in his life, but it really drives home a point. And then he had another great book, which it's a little dated, but the principles are phenomenal. And that's his book, Second Chance. And I can actually tell you where I was when I was listening to Second Chance, and I've listened to it multiple times since. So easy couple books right there.
Nice. I'll link those in the show notes. Rich Dad Poor Dad was very impactful for me. And now I'm spending a decent amount of time out in LA, and it's very much the fake rich in your face constantly. People leasing the sports car just to impress their friends, but they're in debt up to their eyeballs and they're freaking out every night, I'm sure. Or they're completely ignorant of it and they just don't know, right?
Good.
Bull markets are nice for everybody. Yeah. So in your bio, you talk about take back control of your money. So what exactly does this mean, like from your perspective?
Yeah, I think when I was sitting down with the financial advisors, and I don't mean that these people were bad in the least bit, it's just the system. And I want to stress that. I have great friends that are financial advisors. The system is about, hey, I'm going to give you some information there, and I'm going to make a guess on what I'm going to make and whatnot, and what I'm going to contribute to certain things. They're going to make a guess, and together we're going to hope. And I don't find that hope is a strategy. All right. And what it came down to was that I was going to give over control to someone else for my money. Now, why was I willing to do that or contemplating doing that? And why do people do that? It's because we've been told that you're not smart enough to handle your money, right? We get no financial education growing up. I mean, I love what there's some great authors out there right now, like Connor Boyack. He's got this Tuttle Twins series about educating ourselves to see the unseen in the world. And what really resonated with me was like that light bulb of realizing that the whole financial system is about someone else being in control. Okay. The banks, what does any financial institution want? They want as much money as you'll give them. They want to hold it for as long as you'll let them. And they want to give back to you as little as you'll tolerate. Right. And they want to go build wealth with your money. Okay. So it's leverage, right? That's what they're doing. We villainize leverage, But that's what these financial institutions are doing, right? They're doing it to us with our money. And that, when I realized that, the inner control freak in me, the airline, captain in me that wants to fly the airplane, not ride in the back, I realized, hey, if I just educated myself, and it's not complicated, right? That I could do a lot better than someone else could. And just because you tell me that I'm not educated about it, or that, hey, this gets complicated. I mean, look at a prospectus, right? Very few people can digest that prospectus, right? So like, what do? They gloss over, they throw it in the trash. They hear you take my money. That just doesn't resonate with me. I just realized that going and working for someone else for 30, 40 years, at the end of the day, hoping that I don't run out of money, that wasn't going to work for me.
Yes, I think part of this, well, I'm curious why you think people just kind of throw up their hands and say, well, I don't understand this money stuff. I'll just, go right when the whole herd is going right, and not think to look left or look around a bit. Why do you think that is, like, psychologically with us humans in this day and age?
Yeah, it's really about feeling safe. I mean, have you ever felt like, hey, if all these people go, if I go down, all these people are going down with me. It's like that safety, security, right? Like it
Yeah,
takes a
misery
few,
loves company for sure.
yeah, yeah. It takes courage, conviction, confidence, and a little coaching, frankly, to break away from the herd, to do the uncommon. Like, you're a business owner. That's abnormal in the world, right? Um, that's not what we're taught to do. You already broke away. That's what I'm encouraging my kids to do. Like, hey, we're not going to do the norm. You may choose to do the quote unquote norm, but at least you will be educated on options. And I think it's just that psychological. I mean, just look at the peer pressure that goes on. Just you and I could be around our peers, and if everybody's doing something, it's a heck of a lot easier to do that than to go, oh no, I'm not going to do that thing. That doesn't set well with me. It doesn't align with my values, or whatever it is, right? It's human nature, really.
Oh, yeah. There's a great Joseph Campbell quote that I use often, which is, the secure way is actually the insecure way. And I think that like just frames this perfectly, right? Because
Yes, I love that.
this is the secure way, and it's very, very insecure. So just like some to make sure that my listeners and everybody understands, what is this secure way, the way that everybody is going, and then kind of let's poke some holes in it.
Yeah. So the secure way is, hey, I'm going to go to school. I'm going to go get a degree. I'm going to go get my job. I'm gonna max out my 401k. I'm gonna go sit down with a money babysitter. They're gonna take care of my money for me. I'm gonna go work for someone else till I'm 65, and then I'm gonna quote unquote retire, and then I'm gonna hope that I don't outlive my money for the rest of the day. That's the normal secure way, right?
Oh yeah, sounds like my personal nightmare, but 100%.
That
Okay,
is
so
my nightmare.
yeah, I mean, yeah. Okay, so let's break it down. Like, where are the major inefficiencies or disconnects in how this secure path, the standard path is, and where kind of people should be opening their eyes and looking left a few times.
Yeah, I mean, there's a lot of things there. I mean, for one thing, like, just think of a normal job that's giving you a 2 to 3% increase in your wages every year. Is that keeping up with inflation right now?
Hell no.
Not even close right now. I mean, we cannot increase the money supply like we have the last year. What, 500%? We're in that. We're probably north of that now. And if we pass this infrastructure bill, like, I know one lady in Congress says this will be free, but there's nothing free about it. There's no free lunches. So like the cost of our dollars, it doesn't keep up with the wages that we're paid, the things that we can do to increase, is like raising rents if I own real estate, raising the cost of the goods of something I'm selling, right? I can keep up with inflation like that. So sitting there just working for someone else, while the noise, look, the noise is selling us things, right? So Ben, you're going to see roughly 10,000 ads a day. Okay. Do you know what they all have in common?
They're trying to make you unhappy, so you want to buy whatever that is they're selling.
They're disturbing you, right? Well, I always just say they're all trying to get money to flow away from you. And that's the normal message, right? Everybody wants control of your money. Like there's not an ad you see on TV that's not asking for your money, right? Everybody's motivated by one of two things, according to Tony Robbins: pain or pleasure. Pain always wins, right? And so concurrently, while we're having this normal job, we're going out and we're financing everything we buy. Okay. There's no in between. We either pay interest to other people, or we give up the ability to earn interest when we pay cash. It's called lost opportunity cost. So think about the normal person that's watching the TV ads, and they see the car ad, 0% financing on the car. Is there such thing as 0% interest in the car? No, there's no such thing. So it's trickery. It's like 3-card Monte. So what they're doing is, and to give you an example, there was an auto dealership here a couple of years ago that actually had an ad in the paper. And it said, hey, you can buy this F-150. It was MSRP of $35,000. But it said, hey, with all these discounts, dealer rebates, all kinds of cash backs, you could get it for $25,000. And I was like looking at it, and it said, or, like the most enticing words in marketing, this powerful 2-letter word, or 0% financing for up to 72 months. And I thought to myself, wow, I've talked about this for a while, but you all just put it in writing. So I called the dealership then, and this sweet voice answers, and she goes, hey, I said, I just want to confirm, I want to come buy your F-150, but I just want to see. So, hey, it's $35,000, but if I bring cash, I can get it for $25,000 with all your deals. But if I want to get your financing, your 0% financing, the car cost me $35,000. She goes, hold on a second. She puts me on hold. She comes back, music's playing. She comes back, the sweet voice says, yes, that's correct. And I said, wow, that sure doesn't sound like 0% financing. It sounds like you just charged me $10,000 in interest right up front. And there was crickets. And she goes, oh. And I was like, okay, thanks. So that's what's happening in the 0% world. Now, there are some exceptions to it. I've seen furniture stuff. I've called on those. And as long as you pay it off in the first year, it's 0%. But there's always catches, right? They're playing a game, right? But if you don't know the game's being played, it's over, because they're playing the game so well, you don't even know there's a game going on. So your whole life, this 30, 40 years, you're financing, all this money is flowing away from you, and it's flowing away from you really in the form of interest. My old wise mentor, Nelson Nash, who wrote the book, Becoming Your Own Banker, that's the book we teach out of. He figured out a few years ago that 34.5 cents of every dollar, every net dollar, goes to someone else in interest. Wow.
What's a net dollar?
So like the dollars after what we come home with. So let's say I earn 100, I bring home $100. Okay. 34.5 cents of every dollar of that is going to wind up going to someone else in interest, like mortgages, car payments, credit card, that type of stuff. All right.
Based on the average family or household in like balance sheet, which is primarily made up of a like home asset and a large mortgage payment, right?
There you go.
Okay.
Mortgage, credit card, the revolving debt we see, right? And so then concurrently, I'm going and sitting down with someone, a money babysitter, who says, hey, look, I can get you 8 to 10% in your good growth stock mutual fund. Okay. Well, even in that, there's a little sleight of hand. And I'm not saying that this isn't for some people. These were my realizations, and I'm not telling you not to do it because that's not my business. It's just understanding what it is. And I realized that there's this huge difference between, while I was looking at this, between actual and average rate of return. So it's like, just to kind of step back. So I'm going to earn 8 to 10%, but I'm paying 34.5 cents of every net dollar to someone else in interest. I'm sorry, but that's a headwind in your life. I don't care. We can drill down on the math. I'm happy to play the math game, but it doesn't work, right? So our business is called CreateTailwind because we're going to show you how to create this tailwind in your life by recouping all that interest. And as I got to drilling down to go back to that 8 to 10%, this is that normal thing. So let me ask you, we'll walk through an actual versus average rate of return exercise. So let's just say that I start with $100 and I have 100% return next year. What do I have?
$200.
$200. Next year we lose 50%. What do I have?
You lose $100. So you're back at 100.
Back to 100. The third year we have 100% return. I'm back to the $200, right? And the fourth year we lose 50% again. I'm back to $100. Now, what's my average rate of return in there?
Like 75.
It's like it's 25%.
Oh, yeah, minus 50.
Yeah. Yeah, I know why you said it. So it's actually 25% is my average rate of return. But what was my actual rate of return? It was actually zero.
Yeah.
So the average consumer, they just had like a deer in the headlights moment. Maybe they had to pull the car over and they're having a panic moment. But that's what goes on in the sales pitch of the normal, right? Go work your 8 to 5, finance your car. Hey, look at the new furniture you need. Look at that fancy lawnmower you need. All this stuff will 0% that. Go max out whatever you can into your qualified plans because we're going to outperform and get you 10 to 12%. All this stuff. That's the norm, right? And the problem is most people, by the time they figure out there's a problem, it's too late. And that part is a little heartbreaking. My parents wouldn't mind me sharing this, but they kind of came to that conclusion about 8-10 years ago in their retirement. They had followed one of the financial entertainers' advice for years, put money away, went to the financial entertainer's certified guy, and he puts them into some stuff. And I'm sitting down there at the meeting with them, Ben, and I said, so basically you're projecting them to run out of money in 12 years. So I got to start writing a check in 12 years when they're in their early 70s and they're super healthy. I was like, you talking about, smelling up the room. That did not go over well, but that was the reality of what was going on. But that guy had long made his money on them. Right. So that's the normal. And that to me, it's not being honest. We have people all the time say, hey, what's the pitfalls to what you teach? Happy to talk about them. Let's rip it apart. People come to us, we say, hey, we actually encourage you to try to disprove what we teach because I can prove it with math. And that's the fun part, Ben.
Yeah. Well, I think backing up, the reason why everybody overspends and these 0% APR deals are constantly out there is consumption makes up 70% of the economy. So we've built out this entire economy based on the principles that you spend a ton, the portion, the largest amount, right, constantly. And that's propped up all of these industries kind of supporting each other. But then I think about, okay, if the majority of Americans, not just Americans, most people are their savings and their like the wealth effect, all of these things are tied to the stock market, then you'll see like further and further government interventions that this thing can just never drop by 60% because you're going to have old people dying in the streets because they've made their assumptions
Right.
based on this thing going up 8% average per year.
Yeah.
So I think there's a bit of like fighting the money, fighting the money flows and the bigger forces at B. And I'm not saying these are the right ways, right? Like,
Sure.
but how do you think through something like that? That you're like you're going against the grain, but also like there's 300 million people kind of going with the grain, and the government's supporting that grain. Um, how do you think through that?
Yeah, I love that. I'm a rebel at heart. And I would tell you that our clientele are rebels at heart. Can the program we teach benefit all 300 million people? Absolutely. Will anywhere close to the majority ever think about embracing this? Nope, because of what we already talked about. But what we're trying to do is talk to the people that they figured out there's a problem, and they just don't know the solution yet. I talked to a CPA earlier today. He reached out to us. He's like, "Hey, I got a bunch of clients. They're high net worth people. They don't like Wall Street. They don't like the banks. They're Austrian economic fans, more leaning that way, which is really what at its core we're talking about is Austrian economics. And I think they need to talk to you guys. Can you show me more about how you work?" And so that's who we're targeting. A lot, our message is out there for people. Um, you know, whether no matter how you feel about the guy was here on earth, and Jesus asked, "Do you want to be healed?" And I can't heal somebody that doesn't want to be healed, right? You're right. The machine is moving a particular direction, and I'm not going to stop that, right? It is interesting, though. We talk about the rules that the government makes, right? And we have to operate within those rules. And people, whether you like them or hate them, Donald Trump, he was playing by a particular set of rules in the tax world, right? He wasn't stealing. He was just using the rules that the government made. He just did it really well, right? And got incredible depreciation, because we love that, right? We love depreciation as business owners. But in the last COVID bill that passed back in January, there was a little change that happened that I guarantee you 99.99% of people don't realize happened. And it was a change to the life insurance laws. Are you aware of this, Ben? No.
Oh,
so,
no.
Yeah, so we can go back before 1988. People were putting tens of millions of dollars into life insurance contracts as tax shelters, okay? And they've been used as this for years and years. Well, Congress made a couple changes by passing a couple different rules in 86 and 88, and they created something called the modified endowment contract. And you guys have talked about this before. You've had other guests talk about this. And really what it just says is, hey, I can't put $1 into a life insurance contract, get $1 to use right away. That's a very simple way for me to say it, okay? And so there's this ratio that has to happen, and it's really a ratio with the amount of death benefit someone gets, okay? Well, we'll call that line, like if we were to look at an efficiency spectrum of life insurance, we're going to put that MEC line about a quarter of the way off from the left of this line. Well, they made a change. People have asked me before, Ben, well, what if they change the rules? Would we not be able to do this? And I said, you know what? Every Fortune 500 company does what we teach. Every major bank in America, 53% of community banks. Both of the guys that ran for president back in this past November 2020 election, half of Congress. Are these guys really going to make a rule change and cut off their own noses. Well, I was proved to be correct in January. My wife would tell me that I'm always correct. No, I kid, right? But she'll be heartbroken to know that I'm wrong sometimes. But in January, Congress made a change, and they made it so that we can get more money into a life insurance contract efficiently. They moved that MEC line towards the edge further so we can get more money into it quicker. It's a tax shelter. So what do the rule makers know? That's what I'm interested in. What are they doing? The lawmakers aren't putting money in their good growth stock mutual fund and hoping at the end of the day, are they? Heck no, they're not. So that's where we're drilling down. I think that was somewhat of an answer to your question.
Yeah, no, that makes sense. And I mean, with all of these things, I try to understand the other side a little bit as well,
Yeah.
or a lot of it, I guess. I mean, I don't know if you've read, you talked about like infinite money printing and Austrian economics, but like, have you read Stephanie Kelton's The Deficit Myth about MMT being like this savior for everything? And I mean, I had Jim Rogers on the podcast a while ago, and he refers to MMT as more money today. it's the best abbreviation ever for it, but it's interesting to try to at least partially understand the other side, because you certainly are fighting against the grain, but like you said, yeah, I think there's more to meet the eye there. Okay, so infinite banking, you kind of set it up for this, and I think it's about time to get into it. But what I want to cover is the book that kind of kicked this things off. What did you learn from that? And then kind of giving like a TLDR, what it is, how it works, and why people should know about this.
Yeah. So becoming your own banker, it's very important to understand it's not about a product. It's about a process. And when I read, remember, I was asking that guy I was flying with all these life insurance questions. And he's like, I don't understand that, because it's based on a whole life product, not a universal life or a variable universal life product. Those things, frankly, I don't mean any insult to anybody that sells them, but I wouldn't sell those to my worst enemy. There's such inherent flaws in them. And I came from the school of one of these financial entertainers who dogs on whole life for a sport. And I realized through my reading that this was about operating how a bank works, and that the most optimal platform was this very specifically designed dividend paying whole life contract with a mutual company. And it was really important that we did it that way. So the process of how a bank works is dumbly simple. Shakespeare said, if we understand the players in the play, we'll know what's going on. And so it's as simple as this. There's a depositor of the bank. Ben, you go down, and let's just say that you deposit $10,000 into the bank. Okay. Now we work with clients that put, say a couple $1,000 a year in, and we work with people that are putting millions of dollars a year into their policies. But Ben, I'll ask you a question. If you put $10,000 into the bank, to the bank, is that an asset or a liability?
It's an asset to them.
Yeah. And that is your consumer brain answering that. And don't feel bad. The only people that answer this correctly are the CPAs. It's actually a liability, because they have to pay it back to us at any given time. Okay. We're actually creditors of the bank technically, but that's what they have to do. Now, how do they turn it into an asset? Well, they loan
it out.
That's right. That's why they got loan officers running all over the place. That's where the magic happens. Okay. So let's just say that we go out and the bank lends out $10,000, and they're going to sell that money for anywhere from, say, 3 to 28%. Okay. But I'm going to use an average of 5.2%. So they lend $10,000 out at 5.2%. We'll keep the math simple. They're going to collect $520. Okay. Now we deposited the $10,000, and they're going to pay us a generous 0.2%. Now I know that's high right now, but there's a reason why I'm using these numbers. So they're going to pay us $20. Now, the bank collected $520. They paid us $20. Now, how much better did the bank do than we did? Well,
A
they
lot.
actually, yeah, it's 2,600% because 20 goes into 520 26 times. Okay. Now, here's the problem. They did it with our money. Again, back to the control piece. So the owner made all that money. Okay. So people want to bang on debt. Well, you can't be debt free in this country. You got to read the top, you got to read the fine print on a dollar bill. Okay. It's a note, right? That's our whole economy is founded on debt. That's what the Federal Reserve, the money printing, all of that is founded on. So the bank owner made all that money. All right. So there's only three players in that play: the depositor, the owner, and the borrower. And as anyone in your audience, if they're not their own banker yet, they're two of those players. They're actually the depositor and the borrower. So infinite banking is that all it is about putting a wall around all of that so that we can collect all that interest. Remember the 34.5 cents of every nut dollar I said going to someone else? Well, what's our life look like if we just return all of that back to ourselves? Okay. Now, there's different strategies to play within that as business owners, as investors. There's all kinds of different ways to skin that cat. But fundamentally, that's the process of banking. And when I read that in the book, I just slumped down. I was like, wow, it's just that simple. I had no idea. And then I said, well, but my old financial guru that I listened to on the radio says, well, whole life is the worst thing ever. Well, then I started digging into that. And I realized that, well, not so fast. That, hey, used to have 70-80% of people stored money in those types of things. And there's a good reason why, that they do. It's a very safe place to store our money. And if I'm trying to create a money pool where I can go finance the emergencies and opportunities in my life, there's no better place because I don't want my money stored in the banks anymore. So that was kind of the real in the face lesson that I learned reading that book.
Interesting. So, I mean, my listeners, and looks like you probably would recognize this tune of eliminating the big middleman and eliminating that mass markup between depositing and lending. And this is like the allure of DeFi that tons of people are kind of waking up to at this point, that you take $100 worth of crypto, put it in a smart contract, pull out an $80 loan, pay next to nothing to the protocol that you can own. I mean, it's kind of replacing bank shareholders with a more transparent fee structure that can potentially accrue to token holders. So similar games, but this is kind of the allure of this new paradigm change that is DeFi, and I have loads of conversations on that. But with infinite banking, it sounds like you are storing your money in a whole life contract, using that as collateral, taking loan based on that value. But isn't there a lot of trust in the underlying insurance agency that is issuing this whole life policy? And it's kind of just moving your eggs from a bank that's FDIC insured. Yeah, they're taking the spread, but you can own the publicly traded equity and like participate in a portion of that profit share, to another company that is privately owned by shareholders, who has to make money somehow. Like where's the disconnect here?
Yeah, I love that. So thanks for bringing up the FDIC, because there's some huge problems there. The FDIC only they have less than 1% cash on hand of the deposits that they are insuring. Let that sink in a little bit. So
but that's just the banking of over the world's drunk on leverage. Like if everybody went to any bank or there's not enough cash in the system, right?
Yeah. Yeah. So, but the point is, they think that their money is really insured, but it's really not. Like the reality of it is the money that the FDIC has is actually not there. And the
Yeah, but the money
Dodd-Frank,
that banks have or like a company, I mean, I have a company with a balance sheet and I show a number that is far different from like the cash that I actually have, right?
sure. But remember what happened after the '08 crisis? We bailed out the banks. Okay. So like there was banks that were having insolvency issues, and the FDIC was out of money, and we bailed them out through the FDIC. Okay. Well, the Dodd-Frank Act actually changed that. The Dodd-Frank Act, if you are really having a hard time going to sleep one night, read the first page of that bad boy. But they actually changed where the FDIC can't receive funding like that anymore. Now, listen, you and I both know anything can change. The banks rule the world. I know that you and I, as creditors to the bank, we're going to be left holding the bag at some point. Okay, that's how I view it. Okay, but my point is that the FDIC isn't what everyone thinks it is, in terms of this cash flush insurance company that's going to just swoop in and save everybody. I mean, there's limits to the amount of money that your account can have. I mean, I've talked to people all the time that have millions of dollars sitting in a bank account. Well, that's well north of what the FDIC is going to insure, right? So let's juxtapose that to the insurance companies. So the insurance companies are actually regulated by the states and the cash on hand that they're required to have. Now, what we do is we're focused on working with mutual insurance companies, not stock companies. So like AIG, 30 days before they just about took down the world economy, had the highest ratings you could have. So ratings are bought and paid for by and large. Okay. So those don't really matter to me. AIG is a stock company, and guess who gets the profits? The shareholders, right? The policy holders are secondary at best in that equation. So we're using a mutual insurance company. Now, mutual insurance companies are owned by the policy owners exclusively. There's no outside shareholders. So when you read the contract, we have first rights on the money. Now, what's important is to understand the reserves that the insurance companies are required to hold. Whereas a bank is required to hold roughly 10% of their deposits cash on hand, these insurance companies are actually required to carry north of 7% of all their liabilities in cash on hand. I mean, it's pretty fascinating, right? Like they are massively cash flush. In fact, they're sitting on currently tens of billions, if not hundreds of billions of dollars in cash, because where they typically go put money is in these laddered bond strategies. And where bonds are right now, they're not acquiring them right now, but it's even further to the point that they are massively cash flush. Last year, the mortality expense for the life insurance industry as a whole was up 20.5%. Okay. Now that would sound alarming to most business owners, right? It wasn't that more people died in 2020. It was that different people died. People in their 30s and 40s and 50s, instead of living out actuarially, we kind of messed up the tables a little bit. So our mortality expense, the deaths weren't as predictable. Okay. That's what the actuarial tables are based on, is to predict the amount of deaths. So the insurance companies are massively financially solvent. One of the insurance companies that I work with, they're actually the highest in the industry in terms of their reserves. They have 113% of their liabilities sitting in cash. So that's pretty phenomenal when we talk about their solvency. And when I sit down and talk with the executives there, a 20.5% increase in mortality expense doesn't even faze them. Now, if it went on for 10 years, now that's a different problem. And that would impact the entire industry, would impact the entire financial world. I mean, most people don't realize that insurance companies are the largest financiers in the world. There's a few reinsurance companies that by and large finance everything. So it's quite fascinating to dive into that. And there's a lot more to that, but that's the high level approach at it.
Yeah, I think what makes me most uneasy is kind of hitching my cart to this private company, even if it is a whole like owned by the policy owners. I mean, like with Wealthfront, for example, which is a robo advisor, with a few clicks, I can use my diversified ETF portfolio of publicly traded equities as collateral and take out a loan for like 3.5%. And it's pretty
Yeah.
easy. And I can probably take, I don't know, 50% of the value or whatever. So I'm able to, and Wealthfront is taking that delta, and that's fine. But it's a fairly volatile asset there. I'm able to use as collateral and access that. But yeah, I guess what are the biggest risks to doing a process like this with infinite banking? Like, what keeps you up at night? Or people, do this for 5 years and they're like, "Hey, I want out of this thing. I didn't understand
Yeah.
this risk." What comes up the most with that?
Yeah, so I'll touch on one quick thing. You're right. Most like ETF lines of credit or your borrowing ability, 50, 60, maybe 70% if you're lucky, right? We're able to borrow 100%. So the insurance company is not lending us anything that we haven't already placed into the account. Okay, they're placing a lien on my money. My money never leaves, just like your ETF portfolio, and then I'm able to go build wealth with it. Okay, so what keeps me up at night? Personally, nothing in that regard, but where people get themselves stuck with this is actually not using the money. Okay, this is, remember, infinite banking is about a process, not a product. Okay, so let me ask you, Ben, if I were to lend you $100 million and at the end of the year, all you had to do was pay me $5 million in interest, but you didn't have to pay me any principal, would you take the loan?
Depends if I think that I could invest that and make more than $5, 5%.
Yeah, absolutely. So if let's flip that around and say you offered me that, I'd say, heck yeah, I want that. I want that money. And I would turn around and go buy $500 million worth of real estate with it. Okay. And let's just say that I made a measly 5% on the 500 million. So that's what, 25 million, right? And at the end of the year, I say, hey, let's meet. I got your check for you. And I'll take you out. I'll pay. And I'm going to give you your 5 million bucks. Well, you say, hey, do you want to pay back any principal? And I say, no, I'm fine. And I keep that money out working, right? Well, that's the concept, right? All I had to do was pay this simple interest. My money never left the account, but my money was safe. I've got actuarial science on my side. So the fact that they will only lend you 50% of your stock account actually speaks to the volatility of that account. My account can't go down in value. We've
And
got,
is a very probably pull that one from the vocabulary. It's just highly improbable, right?
not in a whole life, not in a whole life product.
If 80% of the population dies from some pandemic, they'll probably go insolvent pretty quickly, right? Highly improbable, but not impossible.
Yeah, but remember, they have the cash on hand. I'm not saying that the insurance company wouldn't be uncomfortable in that moment. By no stretch of the imagination do I portray otherwise. But
Right.
remember, they have the cash on hand to pay that.
Interesting. So
Yeah.
the process is I take $100, I put it into a whole life policy. Is that $100 then being invested by the insurance agency or the insurance company? And if so, is it earning returns? If so, how's it invested, I guess? Because then the
Yeah.
premise is I can take $100 loan, 100% of that, right? And at some low percentage, or I pay interest.
Yeah. Yeah. So the insurance company, you're right. They're taking our premium dollars and they're going to they're putting it to work in a 30 to 40 year laddered bond strategy. That's their big operating um, investment strategy.
But
Okay.
bonds are dead, right? The 60/40 is dead. Like the 60-year bull market in bonds is over Like,
Yeah.
so you do a 30-year laddered bond portfolio, you're getting like 2% maybe.
Yeah. So that's awesome. You speak to this. So these insurance companies still have bonds that are pretty decent. You look back 30, 40 years, we still have some good bond returns. So it actually speaks to the cash on hand that the insurance companies have. They are able to invest in other asset classes in smaller percentages, but it actually speaks to the law change in January, where they're asking for more flexibility in the return that they guarantee. So right now, the insurance companies guarantee a 4% internal rate of return. Okay. Now, I want to be very clear with you and your audience. This rate of return is not what I care about. Okay. The rate of return I care about is what I go do with the money. Okay. I'm looking for a secure platform to be my own banker with. Okay. Is that clear with you, Ben?
No, totally makes sense. Okay, so I give $100. I'm guaranteed 4%, which might change. Then I take $100 loan against this $100 earning 4%. What sort of interest rate do I pay on that?
Well, you're going to pay 5%.
Okay.
In general. I mean,
So
there's insurance companies that are charging higher and lower. I'm
yeah,
just using 5%.
rough numbers. So basically, at the end of year one, I'm net paying $1 in interest, assuming that $100 goes up by 4%, and my $100 I've loaned also goes up by 5. So I'm net paying $1, 1%. So for this to make sense, I need to invest my cash and make sure that I can earn more than 1%. And so that's like the benefits of doing something like this. And then the risks would be that I'm trusting a third party, a life insurance company, even if they're solvent, all the things. I'm trusting that they're able to honor that 4% that they're constantly paying. I mean, if they're doing bonds and maybe they add other assets or whatever. So I'm paying somebody else to make financial decisions on that $100 with the insurance agency company.
Yeah.
Okay.
Yeah, that's correct. Yeah. And really what they're leaning on is their ability to predict the mortality expenses, to control their expenses. We're using mutual companies that aren't pressured by the stockholders to do things for the next quarter, right? They're actually able to use, like, the things that you and I are craving for businesses to do is to think long term. Like, the culture's become, hey, I just got to do this for the next earnings report, right? We'll cut off our nose to spite our face. We'll deal with later, right? The insurance companies actually get to do this, where they get to think long term and not worry about their quarterly earnings call, right? And that part I appreciate. So they're able to predict their cost. We use the mutual companies. The ones that we've gravitated to are typically Midwestern companies that have a lower operating cost. So yes, you're correct. There are bonds that aren't returning much of return, okay? But they're juxtaposed against having very predictable expenses in the mortality expenses and keeping their operational costs very low by where they operate.
I'd be curious how the taxes are treated, and hashtag not financial advice, not tax advice. Get your own accountant or lawyer or financial advisor, all the things, But the interest, that 4% interest, how is that treated from a personal income tax perspective? And then that interest that I'm paying for the loan on the whole life amount, is that deducted from my taxes? How is that treated? Just high level.
I love it. So I was just, before you and I got on, I was talking with my CPA as we're wrapping up my taxes here ahead of October 15th. And we were talking about just this, so I can actually share what she said through our conversation. So the 4% that we're earning, it's technically tax deferred, but if you do this how we're showing you, you won't pay taxes on it because you won't ever withdraw that money out of the account. Okay, we'll borrow the money out over time. Okay, that's a longer conversation. Okay, but remember, my money's growing in a tax shelter. I put post-tax dollars into it. Okay, now the use of the money. If I borrowed money at 5%, to go buy my groceries, okay, well, that's not a tax deductible event, right? But if I go acquire a business, now we're on to something, because if I went and borrowed money from a bank, that interest would be deductible. Well, remember, the insurance companies are just large financial institutions. So the interest that I pay to the insurance company is tax deductible. So Ben, my money is growing. I'm gonna say quotes tax-free in my policy, because I'm not going to pay tax on it, because I'm not going to withdraw my money. Okay. I'm always going to borrow it. The use of the money is a tax write-off. Okay. And I'm going and acquiring things like real estate or businesses where I get to depreciate things. I mean, real estate investors love depreciation, right? I love a negative number on my K1. Okay. I need that to offset other things. So I've acquired things that are tax beneficial to me. Okay. And I'm doing this so like my money is working multiple times. That's the paradigm shift. Most people have thought about my money either sitting in my checking account or buying this real estate. And we are drilling into people. Your money can work multiple ways, just like you talked about DeFi. Fascinating. Okay. I've partook in that before. All right. My money is sitting in my insurance policy and I can use it. It's growing multiple times. And then as I pay back the loan, what am I going to do? Just like the bank. So you take a mortgage from the bank. When you pay, say, your $2,000 a month mortgage, what does the bank do with that payment? Well, they lend it right back out. Okay. That's velocity of money. Okay. They don't sit money there. Okay. That's why we're constantly looking for real estate and business opportunities, cash flow assets, things that I can insure. Okay. So that's kind of like this. You can almost look at like multiple columns happening, all with the same dollars that are in that policy.
Oh, that totally makes sense. Okay. So, I mean, I just did a quick Google, and if you type in infinite banking scam, which is like a way that I normally cross check anything, Dave Ramsey, who is a pretty prominent person within the personal finance space, well respected by a number of people, seems to think infinite banking is a scam. I'd be curious how you react to that, or kind of what the pushback, misunderstanding perhaps from one side or another would be.
Yeah, Dave cracks me up. I've listened to him a lot, and Dave he's got his 7-step program, or however many steps he's got in that thing. He cannot change, right? He is for a very narrow set of people, in my opinion. Okay. He's a financial entertainer. He and Susie Orman are frankly just financial entertainers. Okay. And he'll latch on to one little thing in there, by and large, taken out of context. And he just drills on that. Everyone that knows Dave knows that he cannot stand whole life insurance. Okay. I understand why, because typically life insurance, whole life is sold. If you put in $100, you get $0 to use right away. Okay. But that's not what happens later on. And nor is that how we sell it. Okay. It is about he completely ignores the process of banking. Dave also has a fatal flaw in his teaching, is he does not value the cost of cash. He puts no value on the cost of cash. And what I loved about Robert Kiyosaki is he said, savers are losers. And if you understand the printing press, you and I already touched on inflation, you cannot have money sitting. It's dying, dead money. Motion is a law of God. If air doesn't flow through your lungs, you die. If blood doesn't flow through you, you die. If water becomes stagnant, it becomes poisonous, you can't drink it. And if money doesn't move, it's dead. The banks understand this. Ever heard of the term money follows the sun? right? So to your audience, when a bank closes in New York, it lends money to Chicago banks. When the Chicago banks close, they lend to the Denver banks, and so on. It literally goes around the world. That overnight lending is about them keeping that 10% reserve going. Okay. Money has to flow. So like when our inflation, our real inflation may be in the neighborhood of 15% right now. Okay. Good luck getting anybody to be honest about it. But just look at the cost of your groceries. Look, and if you think that, oh, my bread cost hasn't gone up or that bag of chips hasn't gone up in price, well, compare how many chips, the volume of chips in that bag now to 5 years ago. In some cases, we're seeing stuff that's half the volume now that it was 5 years ago. So Dave completely is missing the point of what we're teaching. It's about not just the interest. I agree with him. Be responsible, live within your means, have savings. Okay. But giving, yeah, he's a little frustrating with how he just ignores the points of this. But that whole cost of cash, let's do an example, Ben, to prove that a dollar has value. So if I were to offer you for 31 days compensation, a penny, and that penny is going to double every day for 31 days. Do you know what it is at the end of the month? Any idea how much that is?
Something obscenely high.
Yeah. Well, on day 20, what is it? Day 22, you'll have $21,000. Okay. So what does Dave teach us to do? He teaches us be good savers, save up, and on day 22, take your 21,000 and go buy your car. Okay. Go pay cash for that used car. I'm totally down with that. Okay. But what happens to my penny doubling? It starts over. And if I start over on day 23, by the day 31, I have $2.56. $2.56 when I keep interrupting my compounding. Okay. Now let's juxtapose that to that. If I never interrupted my compounding, on day 31, I'll have $10.737 million. Now that number gets my attention. Now, why does Dave keep ignoring that? So with the whole life policy, the way that we set it up, I'm going to get both. I'm going to get to put that money in there. It's going to save. It's going to grow for me uninterrupted. And I'm going to get to go buy a car, and I'm not going to interrupt my compounding. Because remember, when we use our policy, we borrow against it. They put a lien on our money. Dave absolutely ignores this.
Yeah, and that makes sense. But all of these things are based on the premise of actually finding great investments that yield higher than the cost of capital and being able to like over leverage yourself. So we've talked like the public markets are shit. All assets are inflated beyond belief. Like even good real estate is being massively purchased up by private equity companies, and you're fighting with the couple down the street that wants the nice backyard for Fido, and they don't care that it's a negative cap rate, and it from an investment standpoint is terrible.
Sure.
So
I agree with you.
And like I think with it's real estate's great because you get the depreciation, but like there's also this unrealistic expectation that it's truly passive. Like I just buy a house for $100,000 and I have a renter that's doing $1,000 a month, and they're just going to pay down my mortgage and all these things. It's going to be great. So I mean, where the key piece of this whole puzzle is finding investable assets that make sense. Yeah. So not looking at the public markets, like where should people be looking for these sorts of things?
Yeah, I'm a huge fan of who, not how. Like who has the skills and the know-how to go get what I want. So I love to partner with people on things. So whether it's real estate investments, finding people that have great off-market strategies. I think that's where the real estate investment opportunities are, the ones that I've purchased that have bore good fruit. have been off-market deals. I'm looking at one right now. We're actually looking at it from there's a business approach with it, and we're working on the EBITDA predictions for that, and whether or not that's a good purchase or not. Again, it's an off-market deal. Like finding people that already have what you want, right? Like Tony Robbins says, find people that have what you want, go learn all you can from them, and partner with that. There's, through all adversity comes amazing innovation, right? So the financial struggles that people are realizing that we're having, I mean, that's what's helped birth cryptocurrency, right? So behind cryptocurrency is the blockchain technology. Most people just think it's about Bitcoin and replacing our currency, but it goes well beyond that, as I know you know. And so finding experts in that field and finding solid advice, those are people that I seek out to partner with. We bought a franchise a year ago. We sought out a franchise consultant that helped us acquire the franchise, that had the things in it that we wanted. So I can tell you that we really seek out the passive component because we're partnering with people. I own real estate that I've never seen before. The tenants to have no idea what my phone number is or who I am, right? That's a truly passive investment for me. I've done the flipping where I was swinging the hammer before. I'm not at a place in life where I'm going to do that anymore. But I really place a tremendous amount of value in partnering with people and trusting people. Relationships are paramount to me, and that's how I've proceeded and found success.
Yeah, 100%. And I mean, as often said, you're the average of the 5 people around you, but what is often not mentioned is you can expand that group if you live in, some tiny town, by books and podcasts and all of these sorts of things. And that's part of what we're trying to do here, is open people's eyes to some of these less often traveled paths toward like this elusive financial independence thing that we're all kind of going for.
Yeah, we tell people, Ben, we're always just trying to show people how to get their passive income to meet or exceed their ideal standard of living.
Oh yeah.
That's the goal.
Oh yeah. Awesome. Well, Nick, this has been extremely educational and helpful. Before we go, where can listeners find out more about you or about what you do? Where do you want to send them?
Yeah, 2 best places, go to CreateTailwind.com. If you want to learn more, there's some resources on there. If you want to talk with me, I promise we have a no hassle guarantee. We're looking for people that want to learn. You won't hear me hassling you whatsoever, but if you just hit the contact me button, we'll reach out to you. Or you can listen to us on our podcast, Breakaway Wealth, where my partner and I have these very similar conversations with people. Those are the 2 best ways to find me. And I appreciate, Ben, having the opportunity to serve your audience and help them understand how banks work and how they can use those same strategies to build wealth in their lives.
Awesome. Nick, well, I'll be sure to link up all of those things. Really appreciate having you on today. Thanks so much.
Yeah. Thanks a bunch, Ben. Have a great one.
You too.
There you have it. Thank you for listening. I really appreciate your support. Show notes, transcript, links, and more can be found on our website at altassetallocation.com. If you'd be so kind, please share this with anyone you think might be interested or get some value from this conversation. If you have any questions or comments, please reach out. I'm always happy to hear them. Lastly, if you're on YouTube, please like the video or subscribe to the channel. If you're listening to the audio version of this, please subscribe to the podcast and or leave a review. This really helps more people find the podcast, and I really appreciate it. Thanks again, and hope you have a fantastic day. Happy investing.